Ajay Srivastav, Chief Executive Officer of Dimension Consulting, joins us live from Delhi. Ajay, morning. Fantastic to have you back. Ajay, the key monitorable for the week gone by was banks and FMCG. Do you think the key monitorable this week could be credit policy?
Yes and no. The reason I say yes is because I think we all waiting to see what the new bazooka from RBI looks like. Maybe they'll reverse, maybe they'll go worse. I think, or they'll recognize the repo rate increase and say, okay, the rate increase is legitimate. But I think the key point coming here is that, is the RBI defining a basis of fighting a rupee rate versus dollar? Because if that is so, they're going to lay a line in the sand. I think there's a lot of pain ahead for this market, because that makes it totally, in a volatile situation versus speculators versus fundamental versus RBI and so on. On the fiscal side, we're looking at a pretty bad policy situation. You saw the drug problem coming in, which is huge. I don't know if people understand that you're asking people to reprice the drugs which are already in the retail store. That's been bad. The fertilizer pricing circular has been abysmal, to say the least, about free market economy. So, we are seeing a mix of signals, both from the RBI side, which is going to be restrictive in nature, on the fiscal side, going to be anti-business in nature. So it's getting into a very potent cocktail, in fact.
So what's the expectation then, Ajay, come tomorrow from the central bank? And it doesn't clearly seem that they're going to ease in any hurry, if not a rate hike tomorrow.
No, see, please understand, now you can expect anything on central bank. They may even come and say, let's say we ease the CRR rate, things were pretty bad in the market, and we've done it. So one can expect anything, because there is very clearly a lack of a direction in RBI's policy stance. It's a flip-flop policy stance central bank has given with no defined target. So I don't expect very well that they might even come and relax the CRR and say liquidity is tight, so we think we temporarily need to do a CRR increase. So please don't hold it that it's going to be tightening. My belief is that they will retract. CRR might come under a little bit of relaxation, and they will not announce the repo rate increase, at least in this one. I believe relaxation is in order, so you would rather tactically go long in Bank Nifty a day before policy than go short.
What are you doing in your portfolio as well? Are you buying into Bank Nifty? Are you buying into PSU banks with the assumption of a pop-up?
You jinxed it. Last November discussion, you said how easy it is to make money. You jinxed it. Absolutely jinxed it. RBI jinxed it, okay? So it's like a bloodbath last week. But having said that, yes, we will tactically go long in Bank Nifty, irrespective of whatever happens the day before the policy. We are slightly long. We have taken off our short positions. We are slightly long, but will go much longer in a Bank Nifty. Our portfolio remains very centric on dollar increases. Tech Mahindra, Biocon, these remain. McDowell remains. It's bleeding now a little bit compared to what it went to 28.20. It's down to 26.95 or thereabouts, but we are still holding on. We have started to build position in UBL again, because it's corrected quite substantially. So, it's a churn, but focus is still where rupee dollar, where the play is, or the consumer story play is. I don't think we're going beyond. Every contrarian play, including L&T, very well, we discussed last time, has backfired, and backfired pretty badly.
Ajay, I would like to draw your attention to HUL. Here you have a situation where HUL is trading at a P multiple of 40 times, and the company is only growing at about 10-11 times. Are markets justified in paying a P multiple of 40 to a business which is only growing in early teens?
See, you have to look at from two perspectives. One is that there is a parent who bought the shares at 600 rupees, which kind of sets a floor. May not be, actual floor in the market, but kind of sets a floor that you don't want to be the price to trade below 600, because, there's a parent who's looking forward to maybe go to 100% at some point of time. So there is a floor which is set 600. Now the question is that the PE becomes 40 or 45. It's also a relative phenomenon that if you have to buy the India story, I'm not a buyer in HUL at this point of time. We were short position. We have taken off the money on the table. But let's assume the fact that people want to go buy the stock. I would still say it's a good buy for people with a 3-5 year perspective who lock up the shares and walk away from it. From a trader's perspective, you are right, absolutely. But come from an investor's perspective, come the elections with the money which flow in the systems, come a good monsoon, come the agri boost which will happen with all the government spending going to the market. If any stock has a greater potential to remain safe and grow, it is the number one stock is HUL and the consumer stories. So you may not like the PE rate, you may not like it, but the fact is that there is not 25% liquidity, out of it 13% in the FII, so 12% floating stock in the market, and the best performing and the best governing stock in the system. So you have to tend to allocate. If you're running an India portfolio, you can't do without HUL. Yeah, the price will run up off and on, But the bottom line is, it's got to be part of the portfolio. And look at a 3-year perspective. This share will give you 15-20% return, even from this valuation. You are looking from tomorrow morning. I am saying 3-year time. This will give you a 20% return in any case.
Ajay, what about IT? Relatively better earnings as well from most of the companies.
Go long. Go long is the word, because I think between TCS and Tech Mahindra and maybe HCL Tech, these trio comprise where you want to put your portfolio. I don't want to go in the mid-cap because I think that's not a story we want to buy into. They've done mediocre. You've seen the results have been pretty mediocre, the mid-cap companies. Infosys, I don't know, it may struggle around. Wipro, you saw the results were pretty disappointing. In a situation like this, they got currency adverse losses, etc. So I don't know what Wipro is doing. So yes, go long, but 3 stocks that we recommend always, and we are there in all the 3s for disclosure purposes, is Tech Mahindra, HCL Tech and TCS. Do not look beyond that, but remain long.
And the point which I want to address with you is that how should one approach private banks and NBFCs now? Because of RBI action, financials as a group, they've taken a hard knock. But even though everything has come down in a synchronized manner, there are some quality names and there are some quality franchise which really can weather this scenario. Do you think it is time to buy into good quality NBFCs and good quality private banks which have only fallen because of in an organized manner?
No, I don't think the time is ripe to go reinvest in them for the simple 2 reasons. I think for the first time you saw the results were showing 2 things this time, including HDFC Bank, that there is tremendous pressure on volumes and business, absolutely. So one would tend to believe that in the next quarter, in the next 2 quarters at least, the volume expansion or the business expansion of these banks will be pretty, I think, tepid at this point of time. So the volume growth of 30-31% we are used to is not going to happen. They may have a margin plus or minus, but the volume expansion is going to be very low. That's one. Number 2 is, no matter what the bank says, I think the pressure of NPS will go up in the system. It's very clear the commercial vehicle portfolio is going to go up. Even the passenger vehicle may start to, at least demand is falling off the road. So therefore, what has to be done is you look at the perspective that this earning of these banks will start to, I think, flatten. They're already flat pretty well. You saw even HDFC Bank is flat for the last 3 quarters. Sequentially, it is flat. So the earnings are flattening out, and for a longer trajectory, the volumes are dropping, and with the RBI coming in and out puts an element of volatility in it. So you tend to still stay away and watch and wait to see that when does this tide turn, because now for the first time, the economic impact of a slowing economy is starting to show in the private bank's balance sheet, and therefore the price correction which was due has happened, but I would still believe not the right time. As I said, tactically you may buy a bank Nifty, but practically you don't want to own it.
Ajay, you mentioned that you're hot on Biocon, something we've not discussed with you in the past. Why are you bullish on Biocon? Do you think the earnings have bottomed out? Because if I look at what they've reported in last 2 years, earnings have been a bit volatile. Things have been patchy. Cleansing and Syngene, nothing is happening there.
No, Syngene, lots is happening there. That's the beauty of the whole thing. One, they had, I think, a $40 billion large contract which came in for a very single large customer. That is one. And number 2 is the rupee dollar. Rupee dollar last year was 50, 54, around there, and now this year is going to be 60. So if you look at the earning profile of Syngene alone, forget the other the businesses of Biocon, that itself, the profit, our estimators should have doubled and will double this year again, because the volumes have gone up. That's one. And number 2 is the fact the rupee dollar is going to give them major upliftment. Number 3, there are huge options contract on which they were losing money, and that option contract expires in, I think, 1 more quarter to go, where they book a loss, and they had sold a dollar at about 47. They were booking losses. That contract expires in September 14. So if you look at the parameters of earning, the Syngene itself is going to be a very big earner for them, and a big negative of the options contract goes away from the table. And the third item is, of course, they've, I think, announced Cleangene and Syngene merger, but Cleangene was not a very big thing. But the Syngene is going to make a huge difference to the profit in the next 12 to 18 months. And that's why we've been long on this. And the whole industry, by and large, the whole industry has done well, because the other marginal players have fallen off the table. You've seen, so there are only 2 big players, GVK and Biocon, left in the system. The order book is very strong. The rupee dollar is in their favor. The option contract goes away. So you want to be there.
Ajay, how does one approach autos now? Because again, divergent trends coming in there, but tactically right now in the macro environment, is it a prudent time to stay put in any of the auto names?
two-wheelers make some sense to me because I think what is going to happen down the elections is the rural income is going to go up and there will be the demand of two-wheelers, and I don't know whether somebody may even come and say gift a two-wheeler for every vote. Maybe that may not happen, just suggest. Okay, but the fact is that they should see better traction. I think the four-wheeler market is pretty well in the dumps right now. I don't think it's going to come out in the next 1 year. So even if you want to place a bet, and you saw that Maruti 800 crore order which has come from Supreme Court, that's what I said, retrograde order. How can you ask someone to pay after 10 years for land he acquired? That's ridiculous. But anyway, so four-wheelers, you don't want to be there because that demand is not going to come up. I think the two-wheeler demand is still remaining strong because the election is down the corner, the rural money flow is going to be very strong, and monsoon has been good. So stay put in two-wheeler if you want to, but four-wheelers I think is a complete avoid.
Ajay, I met someone over the weekend and he told me something which sort of has stayed with me, and the argument which I got from this fund manager is that the current market is really replicating what we saw in 1999-2000, where only one group, which is IT, did well, and currently it's only consumers which are doing well. Rest of the market was ignoring other groups. Do you think it's a matter of time that this crazy run-up in FMCG will come to an halt and markets will start looking at other sectors? Because as of now, it's only 10% of the market which is holding on. Rest of the 90% of the market is in dumps.
Okay, maybe 10 days back, I would have tended to argue the thesis, yes, it is right. But I think given what we've analyzed across the last 1 week, our economic situation is far worse than what we all thought it to be. The reversal is not going to be easy. So to take a call sitting today to say the reversal will happen in the next foreseeable 6 to 9 months, I think it would be a very, very bold shot in the market today. And you don't want to be there. That's the point I'm saying. I'm saying there's too many variables hitting us. So yes, the comfort is that sector which are beaten down, let's go buy it. But I don't think so. This economy is turning around in a hurry. I think every single signal is telling us that the pain is a lot more to happen. That's one. Number two is so-called these beaten down stock valuations. Are they cheap? They are not cheap at this point of time. Even a L&T, which is a bellwether, is not cheap. HDFC Bank is not cheap. So, so you're not looking at cheap stock even on the battered down segment. Leave aside, JP is not cheap. JP's equity value is zero, but it is a stock is trading at 40 rupees, the debt of 40,000 crore. Now, would you call that a cheap stock? I don't think it's a cheap stock at a 40,000 crore plus debt. So, the theory that the stock prices, JP has come down from 100 to 41, therefore has become very attractive buy, I think belies the fact that underlying the stock value is almost 10 rupees or 12 rupees or maybe 20 at best, given the debt structure. So, no, I don't buy the theory. I still believe that the stronger companies with zero debt on the balance sheet, with rupee dollar positive in their favor, will continue to perform in next 12 months, and there is no reason to shift the portfolio. I don't buy the theory. You must focus on the one part only. The other part will dwindle and maybe even go lower because they're not cheap by any standards.
But Ajay, the flip argument here is that look at the land bank some of these companies are sitting on, look at the replacement cost. If you're buying into a JP or if you're buying into, let's say, Kesoram, or if you're buying into a Shree Cement, I mean, these companies have operational capacities, they've got mines, and at the current juncture, it is impossible to replicate that kind of a capacity. So whenever the economy will turn around, they will fly.
Yeah, you actually said the right thing. Whenever economy turns around, and that's the bottom line we are saying, that economy turnaround is not happening in 2013 by far. Government is trying, and I think we must give them enough credit for that they're trying. But it's a big ship, it's not going to turning around. Land bank, yes, it is valid, but land bank has to be saleable land bank. You see in DLF, 22,000 crores of debt, they've not been able to sell Aman Hotel Resorts in this market. They have been able to just sell one plot of land in Mumbai, which was the central plot of land. So a lot of the land bank is where? Is it in places where it can be in cash? The environmental regulation, the development regulation, the demand also is better down in the real estate segment. If you look at Gurgaon, which is the best market in this country, the demand has not been as strong. DLF announced its big premium project in this city just now, and the demand has been more than lukewarm. So it's not the demand is frothing as a system for these land banks or these operation capacities. We are having a systemic demand contraction in the system, which is coming into the play. One. Number two, interest rates are not falling. Therefore, these companies, you saw the study of CRISIL. Not many companies can even pay the interest, forget pay the principal. So where does equity value come from? So theory-wise, yes, it is right, land banks and all this theory. But practically, will there be cash on the table? I don't think the answer is, look at Bata. Operationally, they perform. The stock is doing better. You saw the results coming out. The land bank is where? It's nowhere.